Welcome to Talk Tickers, your deep dive into the latest earnings calls. Today we're dissecting Matthews International's Q3 fiscal 2025 results. And this quarter really showcases their ongoing strategic transformation. It's quite a shift.
Indeed. This call, it gives us the first, full look at the company's new portfolio after that big divestiture. And the market reaction, it seems pretty clear they like the direction things are heading.
Okay, let's jump right into the numbers then. Matthews International delivered a strong beat across the board for Q3. GAAP EPS came in at, $0.49.
Yeah.
That really smashed the consensus estimate, which was around $0.22.
Yeah, nearly double. Significant beat there.
And revenue also came in strong at $349.4 million, beating the street's expectation of about $321.9 million.
Right. Now, the adjusted EBITDA needs a closer look. Reported was $44.6 million, which is, largely flat year over year.
Okay, but that doesn't tell the whole story, does it?
Not at all. The pro-forma adjusted EBITDA, and this includes their 40% share of that new entity, Propelis, that comes in at $51.3 million. Now, that's a robust 14.6% increase year over year.
Okay. So that pro forma number really shows the underlying momentum better.
Exactly. It adjusts for the divestiture and gives you a clearer picture.
And they've also made good progress on debt reduction.
Oh, absolutely. Cut net debt by about $120 million so far this year. That brings their trailing 12-month net leverage down to 3.5x, much healthier.
So the market saw this strong performance. Shares went up.
They did. A healthy uplift. It really shows investors are buying into the strategy, even though reported sales were down because of the SGK divestiture. It's a clear signal the market values this portfolio reshaping.
All right, let's unpack that strategic pivot, starting with the big one, the SGK divestiture and the creation of Propelis Group.
Right. SGK was their lower margin brand services unit. The sale closed May 1st. It brought in $250 million cash, $50 million in preferred equity. And crucially, Matthews kept a 40% equity stake in the new company, Propelis Group.
So they get cash, reduce debt, and keep some upside potential.
Precisely. It's textbook portfolio optimization, shedding non-core assets to focus on higher growth, higher margin areas, and Propelis itself, off to a strong start. They're projecting an initial annual adjusted EBIT around $100 million.
And there's talk of synergies, too.
Yeah, and actually higher than first expected. Management's now targeting $60 million in total synergies for Propelis. They expect a $10 million run rate by year end and a $40 million run rate by the end of calendar 26.
Okay, and for listeners trying to model this, Matthews' share of Propelis results that comes in later.
Correct. It's reported on a one-quarter lag. So for May and June this year, their estimated share of adjusted EBITDA was about $6.7 million. We'll see the full impact flow through later.
Got it. And they're simplifying things further.
They are. They're working to end the transition services agreement with Propelis in fiscal 26. Plus, they plan to sell the remaining SGK German assets, the Rotograve European packaging business. That should bring in over $30 million in net cash by September 30th, so pretty soon.
More debt reduction, getting rid of a break-even business.
Yeah.
Makes sense.
Exactly. It's all about focus and simplification, pruning for growth.
Okay, so beyond the portfolio changes, they've also been focused on costs, right?
Very much so. They kicked off a value creation plan last year, Q4, initially targeted up to $50 million in annual savings. Now they're saying they're on track to exceed that.
And are we seeing those savings hit the bottom line yet?
We are, yeah. Look at the industrial technology segment. Its adjusted EBITDA margin jumped to 10.3% from 4.6% year over year. That's a big improvement. And corporate costs are down, too, by about 13.6%.
So this financial discipline, the cost cuts, the divestiture proceeds, it all supports their guidance.
It does. It underpins their reiterated FY25 adjusted EBITDA guidance of at least $190 million. And remember, that guidance includes their estimated share of Propelis, so it signals real confidence in their earnings power going forward.
Okay, let's shift gears to the core business segments. Memorialization first. Still the steady performer.
Absolutely. Still the bedrock. Reported a modest revenue increase, strong margins, helped by the Dodge Company acquisition and selling off their European cremation business last year.
Right, the Dodge deal, that was $57 million. What did that bring in?
It broadens their embalming and chemicals offerings, fits nicely with their funeral home customers. It's already accretive, expected to add about $12 million in annual EBITDA. This quarter, it added $1 million EBITDA on $6 million in sales.
Any issues with tariffs in that segment? That's been a headwind sometimes.
They seem to have managed it well, found other sources, passed on price increases. Management said no significant impact expected for the rest of the year. So yeah, Memorialization provides that consistent cash flow they can then reinvest elsewhere.
Okay, so where are they reinvesting? That brings us to industrial technologies. This seems to be where the excitement is.
It definitely is. This is where you see the innovation and the bigger growth potential.
Though revenue was down slightly in Q3 here, mentioned engineering and the Tesla dispute.
That's true, those were headwinds. But other parts of the segment were actually up, particularly warehouse automation. That area is seeing a significant recovery.
Oh, really? What's driving that?
Better order trends, improved market dynamics, a much bigger backlog. There's renewed interest in AI-driven automation, predictive analytics, robots. Big box retailers are spending again on their infrastructure.
And the macro trends support that, I imagine. E-commerce growth.
Hugely. U.S. e-commerce projected to grow 10% this year to $1.4 trillion, hitting $2.5 trillion by 2030. That's a massive tailwind for warehouse automation.
Plus those tax law changes helping capital investment.
Exactly. Accelerated depreciation makes these automation investments more attractive right now.
Okay, what else is key within industrial tech? Product identification.
Yes, specifically their new Axiom print head chip product, launching this fall in the U.S. and AMA markets. It's a patented silicon-based print engine. The key feature is disposable print head technology.
Disposable, how does that help?
It offers about 30% lower total cost of ownership, apparently. Fewer maintenance headaches, less downtime, plus some environmental benefits.
And where does this fit in the market?
It's aimed at a $2 billion addressable market in fast-moving consumer goods. And crucially, it's perfectly timed for that Sunrise 2027 initiative.
Yes, Sunrise 2027. Remind us what that is.
It's the global push to move from standard 1D barcodes to more advanced 2D barcodes, like QR codes, by the end of 2027. They carry much more data.
And Axiom can handle both.
Exactly. It prints both 1D and 2D barcodes at production line speeds. Combine that with the disposable head reducing downtime, it's a strong competitive advantage. Plus, it creates high-margin recurring revenue because customers need to use Matthews' proprietary ink.
So you've got the automation speeding things up and Axiom providing the necessary high-speed, data-rich identification. Nice synergy.
Very compelling synergy. Matthews is positioned right at the intersection of those trends.
Okay, finally in this segment, let's talk engineering and that ongoing situation with Tesla. Dry battery electrode technology, DBE.
Right. DBE is critical for next-gen battery manufacturing. Matthews has a lot of valuable IP and know-how here. Despite Tesla's legal challenges, Matthews won a key arbitration ruling back in February. It confirmed their right to sell their DBE solutions to others.
But Tesla is still pushing back.
They are, trying to overturn the ruling in federal court, challenging a patent. Management sees it as baseless, but says it underscores how valuable the tech is.
Is there interest from other potential customers?
Definitely. They have a pipeline of over $150 million in quotes for DBE solutions. They just converted their first production line order for a leading solid-state battery maker.
Solid state. Okay, that's cutting edge.
It is. And they're also working on another significant order, around $50 million for a U.S. customer. This one's for a battery separator coating line that runs at, apparently, twice the speed of competitors' lines.
Twice the speed. Wow. When might that order be finalized?
It's in testing now. They expect formal recognition within, say, 60 to 90 days.
So even with some EV market ups and downs, the long-term need for cheaper, better battery production isn't going away.
Not at all. Reducing battery cost is paramount. Matthews Tech and DBE and these ultra-fast coating lines makes them a key player, especially as focus shifts to domestic supply chains.
So pulling it all together, the narrative from Matthews International is really shifting from restructuring to becoming this compounder in core niches.
That's the goal, leveraging the streamlined portfolio and these strategic investments in growth areas.
So for investors listening, what are the key things to watch in the near term?
Well, definitely the Q4 earnings print. See how they perform against that $190 million plus EBITDA guidance. Also, getting more clarity on Propelis' contribution as that reporting lag normalizes.
Okay.
Keep an eye on integration updates for the Dodge acquisition and any other strategic moves they might announce. And, potential macro tailwinds. If the environment for cyclicals improves, that could help small cap industrials like Matthews.
Good points. And they also declared their regular quarterly dividend, $1.25 per share, payable August 25th. Steady return there.
Yep, consistent payout.
All right, it's time for our This Is Not Financial Advice segment. Based on everything we've discussed, what's an outrageous but plausible trade idea?
Okay, here's a thought. playing on this transformation theme. Consider a long Matthews International, short the lagging industrials basket trade.
Okay, long Matthews, short.
Yeah.
A basket of old school industrials. Why?
Well, the outrageous part is betting heavily on this, seemingly traditional company to not just outperform, but to be a leader in transformation. The plausible part is how they're doing it. Concrete actions. Selling SGK for cash and a stake, the smart Dodge acquisition, aggressively cutting debt.
They're playing chess while others play checkers, you're saying?
Kind of, yeah. They're leveraging real secular themes. E-commerce automation, 2D barcodes, next-gen battery tech. The short leg is against a basket of companies perhaps burdened by legacy assets, slower to adapt, maybe less disciplined with capital.
So you're capturing the difference between successful transformation and stagnation.
Exactly. It's betting on execution and capturing that arbitrage. Again, purely hypothetical, not advice.
Duly noted. That wraps up our deep dive into Matthews International's Q3 fiscal 2025 earnings call. We've definitely seen a company making bold moves, reshaping the portfolio, cutting costs, and investing smartly in growth areas like automation and battery tech.
Yeah, the management team seems to have clear execution and discipline. It's creating, I think, a pretty compelling narrative. It really shows how focusing on core strengths and adapting to change can unlock value. The focus on IP and recurring revenue is key, too, for long-term value.
Absolutely. Remember, everyone, the information discussed today is purely for educational purposes. It should definitely not be considered financial advice. Thanks for joining us for this earnings call summary. We hope this deep dive helped you understand Matthews International's strategic shift a bit better.
Let us know if there are other calls you want us to cover.
Until next time, stay well informed.